Hi, we are from Group 14. We will present you Insurance and Pension Fund Operation.
Hi, my name is Parasun and I'm going to explain the introduction of this chapter. Insurance companies and pension funds were created to provide insurance and retirement funding for individuals, firms, and government agencies. Insurance companies charge a fee called premium for their financial services. Examples of common types of insurance were life insurance, property and casualty insurance, business insurance, and health insurance. The determinants of insurance premiums are potential size of the payment and the degree of competition in the industry. Insurance companies were highly regulated by state agencies, although it varies among the states. The National Association of Insurance Commissioners, NAIC, facilitates cooperation among the various state agencies. The regulation of insurance companies include this important element, which is assessment system, regulation of capital, and Federal Insurance Office.
My name is Natasha Ashikin Mintiusni, and today I would like to talk about main operations of insurance company. There are 6 main operations of insurance company, which is the first one, life insurance, property and casualty insurance, healthcare insurance, business insurance, bond insurance, and the last one is mortgage insurance. There's 4 types of life insurance, which is whole life insurance, terms insurance, variable life insurance, and universal life insurance. And the second one is property and casualty insurance. It protects against fire, thief, liability, and another event that result in economic or non-economic damage. Healthcare insurance, there are 2 types of it, which is the first one is managed healthcare plans and indemnity plans. And business insurance, some form of business insurance overlap with property and casualty insurance. It's protect against the risk associated with ownership of property. And bond insurance protect the investor that purchase bond in the event that bond issuer default on their bonds. The last one is mortgage insurance. It protects the lender that provide mortgage loan in the event that homeowner cannot cover their payment.
My name is Neobok Deng. I will present you 4 types of risks that faced by insurance company. First of all, it will be interest rate risk. Interest rate risk refers to a large amount of fixed rate and long-term debt securities. Therefore, the market value of this portfolio can be very sensitive to interest rate fluctuation. Next, we'll move on to credit risk. Insurance company deal with the credit risk by only invest in security that assign a high credit rating. Insurance company also diversify the securities issuers so that the repayment problems incurred by all the single issues will have only minor impact on the overall portfolio. Next, I'll move on to market risk. Because insurance companies invest in their stock, they are exposed to possible loss on their stock portfolio during weak stock market condition. During credit crisis 2008, those insurance companies with large proportion of their investment in stock suffer from their high exposure to market risk. From 2010 to 2012, their invest gained a large more. The last part will be liquidity risk. High frequency of claims at a single point in time could force a company to liquidate assets at a time when the market value is low, thereby depressing its performance. Life insurance company can reduce their exposure to this risk by diversifying the age distribution of their customer base.
Hello, my name is Fenzi. So now I'm going to present my part, which is about the factors that affect the value of insurance company. So the factors that affect the value of insurance company is cash flow. So the factors that affect cash flow will directly affect the value of insurance company, where the factors is as this, which is the change in payouts, changes in economic conditions, change in risk-free interest rate, change in industry conditions, and change in management abilities. So next is the factors that affect the required rate of return by the investors. So first is the risk-free rate, where it is expected to be positively related to inflation, economic growth, and the budget deficit level. And it also can be affected by the industry conditions such as the regulations and also the management abilities. So in general, the value of insurance company will be affected by the strong economic growth, reduction in interest rate, and also the strong management of capability. So the next part is pension funds. Pension funds provide saving plans for employees that can be used for retirement. So pension fund can be categorized as public pension funds and private pension funds. Public can be either state, local, or federal, and it can be funded on a pay-as-you-go basis. While the private pension plans was created by a private agencies, which also includes industrial, labor, service, non-profit, charitable, and educational organizations. So there are two main types of pension plans, which is benefit plan and contribution plan. Benefit plan is a promises to pay a certain amount of retirement income for life, where the amount of pension is based on a formula that takes into the account of our earnings. While contribution plans are mostly guaranteed, but it is an exception for retirement income. So the amount that's available for the retirement depends on the total contribution that was made into the account. That's all from me. Thank you.
Hello sir, I am Parthi Selvam. Today I am going to present about how pension funds are managed. First, the private pension portfolios are dominated by common stock. Second, the public portfolios of pension are somewhat evenly invested in corporate bond, stock, and other credit instruments. Third, matched funding strategy investment decisions are made with the objective of generating cash flows that match planned outflows payments. Lastly, informal method of matched funding is to invest in long-term bonds to fund long-term liabilities. Now I am going to present about key factors that influence the performance of pension portfolios. The first key factor is pension fund stock portfolio's performance. The formula are shown above. Change in the market condition. The stock portfolio's performance is usually closely related to market condition. Second, change in management abilities. The stock portfolio's performance can vary among pension funds in a particular time period because of differences in management abilities. The second key factor that influences the performance of pension portfolios is pension funds bonds portfolios performance. The formula is shown, where the RF represents the risk-free rate, RP represents the risk premium, and MANAB represents the ability of the portfolio's managers. Thank you.
In conclusion, we can say that insurance companies provide payment to the insured under conditions specified by the insurance policy contract. Insurance companies employ underwriters to calculate the risk of specific insurance policies. They also decide what types of policies to offer based on the potential level of claims to be paid on those policies. As for pension funds, it is a saving plans for employees that can be used for retirement. The valuation and performance of pension fund portfolios are highly influenced by the market conditions.
Thanks for watching. We hope you enjoyed this video.